to start with is really what is minority equity capital. And as Jamie said, this is part of your capital stack. It's a slug of capital that's primarily used to fund growth or provide liquidity to shareholders. What does minority mean, right? Typically, we're at less than 50% ownership stake. That means that that investor likely doesn't exert as much control over the business as a majority owner would. The structure is often referred to as potentially preferred equity or maybe protective equity, meaning that there's sometimes a coupon in the form of somewhat like an interest payment, but really more of a preferred dividend. And then it would have some amount of veto rights over major decisions, not necessarily the day-to-day operations as much, more acquisitions or sales of assets of the company. The relationship between the company or the board and the new investor really should be seen as a strategic partnership. This is somebody coming in that while they're providing capital, maybe for liquidity for the shareholders, also brings a wealth of resources from a strategic purpose, which is really where the growth comes in. The equity or the capital on day one may not be deployed specifically for growth, but there's some reserve there that brings a strategic mind to your company to help with those decisions. And then we have to look at the exit strategy. All forms of capital have some amount of exit strategy. When you're a senior lender, that's just repayment of the debt. But with an equity holder, there's no repayment required. It's a hold period that then gets liquidated at some point or realized at some point, either through the sale of a business or a recapitalization. And then finally, we talk about the return dynamics. And so with debt, which again, I think from an ESOP standpoint, a lot of us are familiar with debt capital, the interest and principal payments required under those terms. In an equity investment, again, aside from that preferred dividend, there's really no contractual obligation to repay. However, there's a return expectation that takes the form of the interest. So it's almost just deferred interest outside of that preferred dividend. Typically, we're seeing 12 to 20% IRR or greater than 2 times a multiple on invested capital. Jamie, anything to add here?
Yeah. Thanks, Joseph. A couple things I might just touch on or expand upon. The interesting thing is this is a very sizable market. In 2024, there were transactions in the 3,100 range in terms of the number of transactions. The value of those transactions, these are all deals in which minority stakes were part of the capital structure, totaled about $250 billion. A lot of the key players here, you've got venture capital firms that are focused on companies that may not have hit quite that product market fit and have subsequent rounds of financing that are in there. We're not going to focus as much on venture capital as our poster child for minority capital investor. What we're going to focus more on is on the growth equity investors. And as Joseph pointed out, it's a good alternative to higher cost debt from a cash coupon perspective. These folks are not going to get their returns based on financial engineering or the use of high leverage. They are going to get their returns by putting their capital to work in a prudent manner, leveraging their own expertise in partnership with the selling shareholders to drive value. And that value is going to come through scale, efficiency, and hence growth. So we think of minority investing as primarily a growth vehicle. I think when you step back and think about some of the things that are important, which we'll talk about a little later on, while it's money, it's a different color of money, and it requires a lot of forethought in terms of who that partner will be. Culture is going to be very important. You want the quote right quote partner to continue to drive value with you. You want to make sure that there would be alignment in terms of not just the growth strategy, but you're also going to want to focus on alignment in and around that exit strategy. What are the time horizons that this investor may have? What is their temperament if the deal tends to move a little sideways or slower than was anticipated up front? How do they behave in the sandbox with you? Those are all key considerations, and we liken that to a dating process. When we get to later in the slides, we'll talk about what the process to raise minority capital will look like. It's not going to be too dissimilar than most other transactions, whether it's raising debt or it's selling a majority stake in your company. But when we just to round all this slide out on the return expectations, what we've highlighted here is greater than a 2 times cash on cash return. Typically, that's in the 3 to 5 times range is what's ideal and theoretically expected. On an IRR basis, again, depending on a lot of different dynamics with the minority position and how the deal is structured, between 2 and 20% is an acceptable IRR, always with sights on trying to maximize that to the extent possible.